Hello, I'm Andrew Lowe, and welcome to In Pursuit of the Perfect Portfolio. I'm here with my co-author, Steve Foerster, and both of us are particularly excited about today's interview because it is with Jeremy Siegel from the Wharton School at the University of Pennsylvania. Hi, Jeremy.
Hello, happy to be here.
Thank you so much for joining us. This is a particularly meaningful interview because, as you know, I got my start in my career at the Wharton School with you as a senior faculty member. And Steve was a graduate student at the time. So this is a bit of a reunion of sorts, I think.
It is. And I remember the time you helped me set up my first IBM AT computer that I had coming to my apartment, and I'm forever thankful.
I was honored to do that, and it was very exciting. I still remember to this day installing the memory chips. And Steve, I suspect you remember some of your graduate school days.
Absolutely. I have fond memories of Jeremy's class, his thoughtfulness and his engagement. It was terrific.
Thank you.
So, Jeremy, I want to start way back. As an undergraduate, you majored in mathematics and economics at Columbia. Tell us about that and how you came to get into finance.
Yeah, it's interesting. First of all, you know, there was no economics in high school, basically, when I go. And so I was a math major. Mm-hmm. And I started out as a math major, and then I got disillusioned with math as it got more and more abstract. And someone said, Jeremy, try economics. You're kind of interested in the stock market, maybe you'd like that. And it wasn't until my junior year I took my first economics class after 2 weeks. I knew I wanted to be an economist. And so, you know, I finished up both the math major and the economics major at Columbia.
So after Columbia, then you did your PhD at MIT, graduated in 1971, and you had an amazing dissertation committee. Rob Solow, Franco Modigliani, Paul Samuelson, yes. All who went on to earn the Nobel Prize.
I was honored.
In your thesis as well, you acknowledge support that you received from a classmate of yours, Bob Merton, who also went on to get a Nobel Prize.
Yes, and I was also honored to be a classmate with Bob Shiller, and I think we're going to mention him a little bit later because he and I have been the closest friends for now over 50 years.
Wow. And we want to come back and talk some more about that. You had another Nobel Prize connection related to your first job, and that was Milton Friedman, who yes. Ended up being a longtime colleague and mentor. And in one of your book dedications, you dedicated to both Samuelson and to Friedman. How did they inspire you?
Well, Samuelson, wow, I mean, just being in his presence and seeing how he thought was, to me, an honor. How fast he thought through all the issues on any topic of economics. I regard him as the greatest theoretical economist of the 20th century. I don't think he was the most influential one in terms of politics. I would say Keynes, and then Friedman, actually probably more influential politically, but in terms of forwarding the field and doing in so unbelievable areas that he did, it just was inspiring to be both his student and to have him on my committee.
And Milton Friedman?
Milton Friedman, when I was in Columbia, I began to read Capitalism and Friedman, and I had libertarian tendencies. I went to MIT, which is not a libertarian. It was sort of anti-Friedman in a way. It was, very much Keynesian, and of course those were when there were all those arguments between Keynesians and non-Keynesians, classicists and monetarists. But I always wanted to go to Chicago as if I could, and there wasn't an opening in the economics department when I graduated MIT, but the Graduate School of Business did have an opening, and a lot of the classes were together. So I was there 1972 to 76. Those 4 years were the last 4 years Milton Friedman was there, mm-hmm. And we both left the same year. I went to Wharton. He retired. someone said, "Well, Jeremy, did you leave because Milton left, or did Milton leave because you were no longer there?" No, it wasn't the latter. He was been to Chicago, virtually all his life. But we maintained a very, very close friendship. Both Ellen, my wife, and I, when he went to San Francisco, and every time we go to San Francisco, we would visit him. And he, just again, he was a treat too, because he was, politically, the way he analyzed things, the way he looked at issues, and of course very, very interested in what's going on in the economy and the monetary markets, which was my field of study, actually monetary theory and policy. So to me, having him as a colleague and then a very, very close friend was very special.
What did you do your PhD thesis on?
The title was Stability of a Monetary Economy with Inflationary Expectations. So sort of a dynamic, what we'd sometimes call Patinkin model for people, did a sort of a dynamic neo-Keynesian model. But when I went through graduate school, that was a period of time when inflation was 10, 12, 14%.
Right.
Interest rates were 10, 12, 14%. So the stability of these economies under inflationary expectations, which often were not treated in the earlier work, I wanted to work on. And it was really building a lot on Phil Kagan's work on hyperinflation, but applying it to a more traditional type of economy. And it was a theoretical piece, but it was very much in line with what I enjoyed working on.
So I want to turn to 1972, where you published a paper that was also fairly theoretical about exchange rates.
Yes.
And this notion of Siegel's paradox has now become part of the standard lexicon of economics. Tell us about what Siegel's paradox is.
That is one of the strangest stories, Andy. I wrote an article called Risk Interest Rates in the Forward Exchange. Now, when I was doing my PhD, we were in a world of fixed exchange rates. Mm-hmm. I was, by the way, very attracted. Milton Friedman had written this thing, The Case for Flexible Exchange Rate. That little book became the Bible for all of us who believe that we should have flexible exchange rates. But the interesting thing about fixed exchange rates, of course, they weren't fixed, and every so often they would have these jumps. And by looking at the forward market, I went backwards to derive the probability that they would devalue. Mm-hmm. So I was basically saying, let's look at the forward market and take a look at that and derive back what the probability over time was that they were going to devalue. But then I noticed something very, very interesting. I said, I used the forward market as an estimate of that. I said, in a risk-neutral world, the two would be the same. But then I noticed that for an American or someone in the United States who deals in dollars, the British pound dollar exchange rate would be flipped from a Briton who was looking at the pound dollar exchange rate. And I said, well, just a minute here, the expected value of 1 over a random variable x is not 1 over the expected value of x.
Right.
So they both can't be risk neutral because there's no equilibrium there.
Right.
Now, the interesting thing, that wasn't the major thesis. I sort of put it on an aside and just said, this is a little curiosity. I haven't worked it out. The rest of it was trying to derive these probabilities. But that particular, as you say, paradox caught the minds of so many people. And years later, sometimes 10, 15 years later, I would get articles of someone said, Dr. Siegel, I think I've solved your paradox. I never worked out anymore. It wasn't my field. I wasn't really in international economics. So I had gone away and I had sent it to a few authors that say they've been working on it. Mark Kritzman actually wrote a book about major paradoxes. He put mine first. Wow. And I think the actual answer has to do with the fact it's index numbers. When we talk about a price level, we're really doing index numbers. Yeah. And as a result, if you disentangle that, you can get down to the basics.
Now, is there any kind of arbitrage going on here? Have you ever traded on this?
No, I've not traded on that because, again, if you sort of disaggregate and do it in terms of consumption goods instead of price levels, and it took many years to figure that out. The paradox seems to disappear.
I see. Okay.
So over time, you gravitated from interest in economics to interest in investments. And
yes.
it's been now almost a quarter century where you wrote the first edition of Stocks for the Long Run. Yes,
Absolutely.
which is now in its fifth edition.
now.
Became a bestseller. It sold hundreds of thousands of
Yes.
copies.
Yes.
And it's probably one of the things you're most well known for.
Yes.
The cornerstone of it is that investors should have equities in their portfolios. Can you talk some more about the book and what was behind
absolutely.
it?
And I'll tell you, it's really interesting because, again, I always had an interest in markets, but again, going back to the '60s, a PhD in finance in 1962 or '3 is not like it today. I remember I said in one course was how to issue an IPO, and went through all the institutional things. This doesn't interest me. And people said, listen, Jeremy, you're interested in interest rates, macro, and markets. Go in economics, and then you can kind of move into it. So that's why I really was. If I was born 10 years later, I would have had a PhD in finance. But given when I was born and what the subject matter was, it was this was the best way for me to go. And I did all my research on it. Got my tenure at Wharton on my work in macro. And then in I think it was about 1987. I was at Wharton for 10 years. One of my colleagues, Marshall Bloom, called me up and said, Jeremy, I just got a call from the New York Stock Exchange. They're coming on their 200th anniversary, and they want to write a book about the history of the exchange. And I said, he said, I know you've done a lot of macro, but I know you like markets. Do you want to kind of shift and do that with me? And I said, I'd love to. I was ready to kind of move on my research. So I decided I was going to look up historical returns and let my friend Marshall do the institutional stuff. I also did policy stuff. And I went all the way back to 1800, using Bill Schwert as that, and then the Coles Foundation data, and came up with these long-run returns. We presented New York Stock Exchange. They said, we love it, but there's too much here. And we have to pare it down. And we think, given what we wanted, more of the policy and the institutional was that. And then my colleague, Marshall Bloom, in really tremendous act of kindness, said, Jeremy, stay co-author on this work, even though, he did most of it. And why don't you write a book on all this other yourself? And again, my good friend Bob Shiller, who of course, I met as a fellow student at MIT, he also encouraged me. I wrote a couple columns for Financial Analyst Journal Portfolio Management, got wonderful receptions on some of the background, and so that decided, hey, I'm going to write a book. I'm going to, all these years of thinking about markets and how it fits into macro, and I think one of the novel things that a lot of people said is it is really macro grounded. While so many other people in finance don't have as much macro grounding, this was very macro grounded, and I think that gave it a special, and of course the long time series, and what can we conclude from that long time series?
So Jeremy, for the handful of people out there who have not read your book, can you please just summarize the main ideas?
I think the main ideas that struck people, not so much that stocks had better returns. Everyone knew in the long run they had better returns. But I think what they didn't know is that once you go to longer periods, the relative volatility of stocks goes down. In other words, it was not a random walk in the long run. In the long run, it had properties of what we often call mean reversion, reverting to the mean. And that trend line, which when my first edition came out, was 6.7% per year return after inflation. Even in the updated edition, it's 6.7% return after all the volatility we've had in 20 years. It's gone back. So it was mean reverting in the long run, which made the long run profile of risk relative to bonds much less scary than the short run profile of risk.
Now, let's just be clear here. By long run, you mean from 1800 to the present.
Well,
is that
but
right?
I was also looking at 20-year period, 10-year period.
Sure.
So 5, 10, 15, and the standard deviation of average returns went down far faster than the random walk theory
Right.
would predict.
So the overall message is that investors ought to keep money in stocks for the long run.
Yeah, if you're in a long run orientation, and anyone saving for 401ks, IRAs, they're looking ahead to their retirement. The bulk of their assets should be in equities. I mean, I think that's really what jumped out in terms of looking at the relative risk on the different time periods as the profile.
Now, our viewers probably don't know this about you, but I did, because when I was at Wharton, it was pretty clear that you not only talk the talk, but you walk the walk. You actually were quite an active investor at the time in many different asset classes. Isn't that right?
Yeah, well, it's interesting. I played the market on trends. I was very honestly never good on individual stocks. So I said, hey, I'm going to forget that. The market's efficient, much more efficient than I am at individual stock. But in terms of sort of playing the market, playing the futures, I played the January effect for a while.
Yes.
I mean, it doesn't work the way it used to, but
Right.
for a while I had fun. I learned an awful lot about actual trading and futures markets and indexes, of course, and the nature of indexes, which of course is a key to diversification in the long run.
So I want to turn to April 1999, because you wrote an op-ed piece
Yes.
about the internet bubble. I don't think anybody was calling it a bubble at the time, but you did.
Yes. Well, actually, there was the April piece about our internet stocks overvalued out there ever, which came in April. My most famous timing piece was the following March. March 14th appeared as the lead op-ed and the Wall Street Journal. Big cap tech stocks are a sucker's bet.
Wow.
Now, people said, Jeremy, you were within 2 or 3 days of the absolute peak of the NASDAQ. How did you do that? And I said, it was damn luck. Absolutely. Don't think I knew it was the peak. I just knew it was crazy. And basically, actually, I based it on a lot of this because there was one chapter that I talked about the Nifty 50 of the 70s, and I said that no big cap stock really deserved a PE of over 50 or 60.
Why?
And they didn't grow. Once they got to that size, they couldn't grow enough at the far end to justify. Polaroid had the highest at 90. We know what happened to it finally, and many of the others. Now, of course, people talk about today, whoa, are we in a different world with Amazon and Apple and Facebook and a few of the others? Except for Amazon and a couple of others, really. I mean, Apple is a reasonably priced stock. I mean, 20 or less? It was 10 for a long time. It never got to the average tech stock at the peak in the bubble of the S&P 500. I'm not talking about the crazy internet stocks. Was 90 times earnings.
Wow.
And in fact, a lot of advisors were moving those. They said, we'll move to IBM, which is only selling at 50 times earnings. We'll move to Microsoft, only 50. That was considered conservative. So people who tell me today, Jeremy, isn't this like the 1999 bubble? I say, no way. We're nowhere as crazy as we really were then. I mean, I do know there's a couple stocks out there, but in terms of the overall market, nowhere.
And is it PE that you really looked at?
Yes,
to
I
get a
really
sense?
did look at price earnings. I think that is very important. And in fact, when I'm giving talks today, it's PE or adjusted PE that I look at to project real returns on the market going forward.
So some of these themes came out in your follow-up book in 2005, looking at
Future for Investors.
Future for Investors.
Yes.
And I love the full title. Why the tried and true triumph over
the bold and new.
The bold and new. It's a great title. Some of these themes came up in terms of growth traps.
Yes.
And you talk about some other themes as well related to the aging population. and questions that when you present your results from your first book, you got these questions about, well, which stocks should I be investing in, and what about what's going to happen when boomers retire?
Right.
So how did you address those issues?
Well, it was very interesting. I started out that book, and I said, suppose in 1950 you're given the choice of two stocks, Standard Oil of New Jersey, which of course has become ExxonMobil, and IBM, which is still IBM. And you could invest in either one of these stocks. And I'm going to give you Aladdin's lamp, crystal ball. I'm going to tell you their earnings growth over the next 50 years, and both Standard Oil and the other. Which would you choose? Well, when I do that, IBM just beats them all the way. Everyone says, well, IBM. I said, no, the bigger, better returns were Standard Oil of New Jersey.
And why was that?
Because it had a lower price. And when you reinvest the dividends, from that lower price, or when the firm engages in buybacks at that lower price over long periods of time, that shoots you ahead. And that was a big surprise to me, because everything is earnings growth in Wall Street. And in the short run, yes, that is an important factor. But really, in the long run, a lot of it was its PE ratio, dividend yield became very, very important as the long run. And one thing that is often made of, and I talked a lot about it, the best performing stock, either from 1929 or almost every period, is Philip Morris. And people say, Philip Morris, how did that do? Well, for a 15-year period, everyone thought it was going bankrupt. It was selling at around 5 PE and had a yield of about 12%. Now, you're reinvesting the dividends when you do long-term returns. So as long as that company didn't go under, the amount of shares you finally got at the end of that period, when it recovered to the old level, it shot above every other stock. And so it's sort of, when you explain it, people understand it, but it is counterintuitive. Those are a lot of the ones that I think, and one of the reasons why I think in the long run, at least from the historical data, value stocks did better is because of that reinvestment at a lower PE ratio in the long run tends to get higher.
So that idea sounds a whole lot like what Benjamin Graham once said about, in the short run, the stock market is a voting machine, and in the long run, it's a weighing machine.
Right.
Do you subscribe to value investing?
Yeah, I do.
Okay.
I mean, and I'll tell you, it was the bubble in 1999 that switched me. I mean, I was a walking advertisement for Vanguard for the first 3 editions. I always thought that Jack Bogle should have paid me, because I just said, that's the way, just buy their index trust and go away and sleep and all that. But in 1999, I knew the tech sector was overvalued. And back then, I mean, I couldn't easily take that out. I mean, I know there's sector funds now, you could short the sector, all that. I said, just a minute, I want to hold the market outside tech. I want to hold something that's more based on value than just capitalization, because that can go wrong at times. Now, no one knows when it goes wrong. People say, well, why didn't you short it and all that? Well, you could argue that way. But nonetheless, that's what began me to think, hey, there might be another way to index. We call it smart beta now, or shading, or whatever you want to do. And that's really how I got involved with WisdomTree on their fundamentally weighted indexes.
So what about the aging population? So
yeah,
is
that
a
was
reason
another.
to...
And that was, one thing was a little awkward, because in a way this was one part of it and the other was a little different, but I had 2 good ideas I thought should be talked about. Everyone said, what happens when all the baby boomers retire? Everyone's going to be selling, and there's not enough young people there that's buying. And what I pointed out is, as long as we have growth in the emerging markets, China, India, or whatever, they're the young people. Now, of course, China, because it's one-child policy, is not getting as young as it should. India, and then perhaps the Middle East and Africa, but they will be the savers. So I did a long-run model and really showed that we could support markets into the 21st century by having the growth of the emerging market economies come up, and you don't have to be what's called a demographic pessimist about what's going to happen to the equity prices.
Again, your macro training helped.
That was
out
exactly, I wanted to try to tackle that. It worried me too, because I knew there was a population bulge. I was a baby boomer, and I knew that we were going into retirement. We were going to be selling our portfolios to finance our consumption. Who was going to buy it? Are they rich enough to buy it? That was the question.
Now, you've had a number of debates with your lifelong friend, Bob Shiller.
Yes.
And we've been fortunate to have Bob as part of this series as
Yes.
well. And it's wonderful seeing the two of you together, because it's pretty clear that you're such close friends. But what have you debated, and where do you fall on various issues?
Yeah.
What are your agreements and disagreements?
I met Bob on my first day at graduate school at MIT, 1967. So it's now more than a 50-year. We liked each other immediately, and we've maintained a really close personal friendship. Now, people say, but he's been a bear, and, or they called Bob the perma bear, and they call me the perma bull, and how do you get along? And, you know what? We respect each other's point of view on that. And, Bob turns out to be much more risk averse than I am. He was always worried about risks out there. I would walk at the edge when I wanted to see a view, and you'd say, "Jeremy, come back from that. He'd say, come back. Don't go so far there. Something could happen. You can trip." So I was always a little bit more risk taking than his one. Maybe that has to do with the psychology of that. But we still maintain a very, very close friendship. And actually, what was there is the CAPE ratio issue we might talk about also, but right after Trump was elected, we both said he and the Republican platform were good for the market. He was a bull. We were actually on, I think, NPR. We were filming in New York early on, and they asked us a question: do you think the market's going to be higher a year from now? And both of us unequivocally said yes.
So what were you saying in 2007 and 8 when Bob was talking about irrational exuberance? How did you react to that?
Well, I agreed with him. Don't forget, the original irrational exuberance was the 2000 bubble.
Right.
And it came out right. I mean, my God, his timing couldn't have been better either. It comes out in March of 2000.
And yours.
And my piece on that. I mean, we both kind of hit the jackpot, and we were exactly alike on that. Of course, the CAPE ratio, which the cyclically adjusted PE ratio, which has become so famous, was John Campbell and Bob's work that they did in 1997. Now, I've written an article that shows that is too bearish a way to look at the stock market.
Oh, for our viewers, can you describe what the CAPE ratio is and what your view on that is?
Right. CAPE ratio is a very simple idea. We all know price earnings ratio, which is a fundamental to look at value, is price over earnings. But what earnings? Do you want to take last year's, this year's, projected 12 months? And Bob said, I was reading, Graham and Dodd, and he said, take the last 10 years. So what he did is say he averaged the last 10 years of real earnings on the S&P. And again, having the Coles Foundation data, went back to 1871. And he then took that price earnings ratio and he regressed the next 10 years return on that price earnings ratio in 1996. And I think he had an R squared about 40%, which for the stock market is great. I mean, anything like that. So he could explain like 35-40% of the next 10 years returns by looking at that particular ratio. I was impressed with it. The big problem that has happened with it, and why it has not been a very good predictor over the last decade, is because since Bob wrote that article, FASB, Financial Accounting Standards Board, has changed the way firms report what's called GAAP income, reported income. It particularly marked to market. And what that meant was during the recession that followed the financial crisis, earnings just totally cratered much more than the Great Depression because of the new accounting. So as a result, when he does his 10-year average, and we're still in that 10-year average today because it's not a weighted average, it's a simple average of that. When you average a few zeros in there, you're going to have a very low denominator and you're going to have a very high numerator, and it's going to look like an overvalued market. So what I said is you got to redo it, and I suggested some other ways of looking at it. It brought down dramatically the degree of overvaluation. Now, I've talked to Bob. Bob says, yeah, that's right. I said, well, your website still uses GAAP. He said, yeah, everyone's used to that. I'm leaving that. Bob actually doesn't talk a lot about CAPE. He's on other things. His mind is always amazing, and he keeps on producing, and he doesn't like to he acknowledges the CAPE, but he doesn't really like to stick to the CAPE any strict way. In fact, one time I think one of the questionnaires asked him, and he said, "Oh yeah, I'm about 70% in stocks," when the CAPE ratio was really high. yeah, but it's a way to look at it. And actually, I think if you make some of the corrections I suggest, it is a very useful way of thinking about longer term returns.
You mentioned WisdomTree Investments earlier. I want to come back to that. You've had a fairly long association with the firm, one of the largest, if not the largest, asset manager that focuses exclusively on ETFs or exchange-traded funds. Can you talk a little bit about ETFs and what do you see as their role for the average investor?
Yeah. It was interesting. So Jonathan Steinberg, son of Saul Steinberg, who was a graduate of Wharton and a very generous contributor to Wharton. In fact, I'm in Steinberg Dietrich Hall, so we helped on the renovation.
Spent many
on
hours.
that. So his son called me up, and this was in 2003, 2002, 2003. Said, Jeremy, I've been, working on variant indexes instead of weighting by market capitalization. Let's weight by earnings or dividends. But you guys, you have the ability to do all the econometrics and math. Would you like to look? I said, yeah, I'll look at those. And we actually, my research assistant and I, we looked at those, and we said, wow, these have very good historical risk return.
Compared to the typical market
capitalization weighted. In other words, instead of weighting by, just market weighted, what you did was you weighted the firms by their share of either earnings or dividends, which of course means that every year or whatever time period you decide, you have to rebalance your portfolio. Those that have gone up more than their earnings, you sell down. Those that do not go up as much as their earnings, you increase. So that adjustment of your portfolio on the basis of fundamental factors is called fundamentally weighted indexing. And when I asked him, I said, well, John, what are you going to do? He said, we're doing ETFs. And back then, 2004, there wasn't very much. There was a spider, which is S&P and the NASDAQ. But we had to, before the SEC, we had to spend a long time convincing themselves this was a valid way to look at ETFs. But he wanted ETFs. And another thing I told him, I said, I've been a Vanguard fan, so we've got to charge. We can't charge much. He said, I agree with you, we're not going to be charging. When we actually came out for non-index, we were the cheapest of all the providers. And I've been in a lot of competition since, and they've exploded in ETFs, obviously, since then. But we were definitely one of the first.
Now, was it considered an active ETF or a passive ETF?
It was, we played with the definitions. Now there's these active ETFs where it was passive in the sense it was a known formula that anyone could replicate. We only rebalance once a year on the basis of the known formula. Now, since then, they've become almost ETFs that are based on, to active management, so we're nowhere near that. So it's still a passive index, just calculated differently than the cap-weighted indexes.
Yeah. So now we turn to the highlight of our discussion, which is to talk about the perfect portfolio.
Oh, wow.
Now, we understand that there's maybe no one single definition, but given all the research that you've done, particularly stocks in the long run, I have a feeling that I know what is going to be in that perfect portfolio, but can you tell us a little bit about what our viewers can think about as a perfect portfolio?
Well, definitely stocks as the benchmark. Half of the world's equity capital is outside the U.S. if you look at market value, and you should not ignore the global picture, particularly today because we are actually they are cheaper in terms of price earnings ratios than we are. Now there is a little bit of sector adjustment that you do, but basically they're in a low interest rate environment, they're very, very reasonable. So don't ignore, I know it's like pulling teeth to get people international, but if you can get there, 50% even is not unreasonable on there. Bonds don't look good to me. People ask me, do you own it? Well, I have cash. Obviously, everyone needs some cash. I said the only bond portfolio I had is back in, I think in 1978, Vanguard came out with its high yield fund. And I bought it and put it on automatic reinvestment of dividends. And the dividends are so high that, believe it or not, its return is almost stops over the next 30 years.
Wow.
I mean, it's maybe 1 or 2 points below, and I just keep it there. So it's kind of high yield is quasi stock. So I don't own any treasuries. And especially today, with yields being so extremely low, I prefer cash as my cushion rather than longer term bonds. And now that cash returns are actually coming up, it's not unreasonable.
And how about tips?
I like tips. I like tips better than the nominal bonds. Again, on the 10-year tips, today it's 80 basis points. When they first came out in 1997, it was 3.5 to 4. I mean, that was incredible yields. Those were good yields. So today you're barely, keeping up with inflation, a little bit beyond, and it's taxable too. So you have to make sure you keep it in a non-taxable account. I prefer those to the nominal standard bonds, but I don't think their returns are good enough. I mean, you can get dividend-paying stocks. I mean, the average now is almost 2%, and the growth of the dividends over the last 10 years since the crisis, has been remarkable. We've almost had 10% a year dividend growth, and firms can even do more if they want to, because less than half of their earnings are paid out as dividends.
In terms of the equity investments, what's your view in terms of pure index fund versus something that either might have a tilt or sector specific?
I know it's been a rough time for value investors. We definitely know over the last 10 years, 5 years. But I still think, for so many reasons, because it's like the growth trap that you mentioned from my book, Future for Investors. People get mesmerized by growth and they overpay. And over time, even if you hold them, whatever dividend reinvestment they do, it's going to be at a smaller amount than if you hold those value stocks, reinvest, or get the buyback return that you're going to get on that. I think that they're going to still perform. So I would definitely tilt towards the value side.
And what do you think about rules of thumb like dollar cost averaging? A number of individual investors seem to like that kind of...
It's funny because, in a way, when my reinvestment of my junk bonds is like dollar cost averaging.
That's right.
It also serves a psychological purpose in the sense that people hate to buy at a point and see it go down. If you plan your buying, you're going to hit some highs, you're going to hit some lows, but you're going to hit the average. I think it serves a really good psychological purpose for people who are, have that regret in their portfolio. Oh my God, I could have waited a week and get cheaper. That's a good idea. So, I mean, continuously putting that in, you're going to buy more shares when they're down than when they're up. And I think some of the reason my returns from that junk fund is so large is because when they're down and the reinvestment comes up, I just get so many more shares.
What should investors do who are prone to emotions, and how do you set that aside in your portfolio?
That's the hardest. I encourage them to read my book. There's graphs that calm you down when you look at, it's funny because when I showed my big 210-year graph, the bear markets, even the 1930s, are little blips. They said, oh, come on, was that the Great Depression? Was that? Yeah. It sort of disappears in insignificance when you look at the upward thrust of the long run values. So, if you look at that longer run, you're just not so upset by the shorter run. And by the way, I'm not one of these people that like high cost advisors or something else. But if you need someone to help you stay focused and in equities when times are bad, definitely an advisor can help you an awful lot. in terms of doing that. We find that a lot of people who just use the index funds and say, I'm paying 3 basis points, 5 basis points, whatever else, they end up doing worse because they buy too much at the top and sell at the bottom. Even though it's not a stock selection question, it's not a cost selection. It's the emotions that overcome the long run judgment they should have.
So speaking about long run judgment, as a macroeconomist, you obviously do think about the long run, maybe more so than the short run. What are your views over the next, say, 10 or 20 years for both the market and the aggregate economy?
Well, no one can predict, but I think there are good things coming. We see the advances in AI, nanotechnology, in robotics. They're on the horizon. You don't have to be in those companies. There's going to be fierce competition in terms of that. I think everyone is going to benefit. Keep focused on that long run. As I say, despite the political winds that move one way or the other, there's still, look at China has a stock market, Russia has a stock market. The idea is we're going to abolish these markets. No one really has that serious idea anymore. They know markets are really important for allocating capital in the future. So I think you're looking ahead to a situation where, and the emerging market, China, 1/4 per capita income of the United States, 4 times the population. If it gets to 1/2, think the growth is unbelievable. It's another China, it's another U.S. India is even more, with 15 to 20% per capita. If it gets to 1/2, and countries have gone that far. South Korea has gone to 1/2. So there is unbelievable potential in those countries to grow, and they're going to buy our goods as well. You don't have to buy their companies to get their returns, because our companies are going to serve them also.
Well, one of my fondest memories about the Wharton School days was going by the classes that you teach and realizing that there was literally standing room only, because MBA students would actually, even though they weren't enrolled in your class, they would go in there to hear your morning briefings about your perspectives on market dynamics. So on behalf of all of our viewers and readers of In Pursuit of the Perfect Portfolio, thank you so much for sharing your wisdom with us, and we really appreciate it.
It was fun doing it and being with you. Thank you both.
Thank you.